All right, let's talk about something every single investor has to face, but not everyone truly gets their head around. I'm talking about those brutal, gut-wrenching stock market crashes. And believe it or not, we're going to see why they might actually be normal. So just for a second, put yourself in this situation. You check your portfolio, everything's fine. You check it again a few hours later, and poof, nearly half the value of one of your biggest investments is just gone. That is a feeling that will test anyone's resolve. I don't care how long you've been investing. And look, this isn't just some made-up scenario to scare you. This is exactly what happened to investors in Fiserv, a huge company in the fintech world. It was a sudden, absolutely catastrophic drop that left everyone scrambling for answers. To give you a sense of the scale here, that 44% plunge wasn't just a number on a screen. It vaporized over $30 billion of the company's value. In a day, that's just a mind-boggling amount of money to vanish into thin air. You know what's bad when the company's own CEO, Mike Lyons, comes out and says something like this? He's basically admitting, yeah, we're not delivering. When the person in charge says that, it sends a powerful signal to the market, and it's not a good one. So this really gets to the heart of what we're talking about today. When you see a crash like this, is it a sign to run for the hills? Is the company doomed? Or is this kind of insane volatility just the price you have to pay for a shot at great returns? Let's find out. Okay, first things first, let's put Fiserv under the microscope. If we can understand the why behind this one specific collapse, it'll give us a much clearer lens for looking at the bigger picture. So what happened? Well, it was like a perfect storm of bad news. The company slashed its forecast for the rest of the year. Their revenue growth basically ground to a halt, from 8% down to just 1%. And their star player, the Clover payment system, saw its growth get chopped in half. Oh, and to top it all off, they're facing a lawsuit that claims they were fudging the numbers to begin with. It was just a toxic cocktail for investors. All right, before we go any further, we need to get on the same page with a key term you're going to hear a lot: drawdown. It sounds technical, but it's super simple. It's just the measure of how far an investment falls from its absolute peak to its lowest point. Remember that word, because it's at the center of this whole story. Now we're going to zoom out. We've seen what happened with Fiserv, but its story is really just one example of a much bigger and honestly pretty shocking truth about what it takes to be a long-term investor. The legendary investor Charlie Munger, he did not mince words on this topic. He basically said, look, if you can't stomach watching your investments get cut in half without freaking out and selling, then you're just not built for superior returns. For him, these huge drops weren't a bug, they were a feature, a toll you had to pay. And here's the wild part. Charlie Munger might have actually been an optimist. A massive study by Morgan Stanley looked at thousands of US stocks over nearly 40 years. And you know what they found? The median maximum drawdown wasn't 50%. It was an absolutely jaw-dropping 85.4%. Now, let's break down what this table is telling us, because the timeline is critical. That journey from the very top to the absolute bottom, that typically takes 2.5 years. And then, if the stock actually manages to recover, it takes another 2.5 years just to climb back to where it started. We're talking about a 5-year round trip of pain and uncertainty. But here's the gut punch. Most of them don't make it back. A little over half, 54%, of stocks that go through one of these massive drawdowns never ever see their old highs again. The odds are literally worse than a coin flip. So that's the million-dollar question, isn't it? What separates the stocks that come back from the dead from the ones that are just dead? Let's look at 2 real-world examples that tell this story perfectly. So here we have a tale of 2 companies. On one side, you've got NVIDIA, the AI chip superstar. On the other, Foot Locker, the sneaker store we all know. Both of them at one point got absolutely crushed. Their stocks fell over 90%. But just look at what happened next. Their paths could not be more different. So what was the difference? It comes down to the reason for the crash. NVIDIA's problem was cyclical. The whole semiconductor industry was in a slump. It was painful, but the fundamental need for chips wasn't going away. Foot Locker's problem was secular. Their entire business model, selling shoes in physical malls, was being permanently disrupted by the internet. The result? NVIDIA was back to its old peak in about 5 years. Foot Locker, it's been over 22 years and it's still not even close. So understanding that difference between a cyclical winter and a secular death spiral is literally everything. It means when one of your stocks is in total freefall, You need to have a process for thinking clearly instead of just hitting the panic button. So you have to ask yourself some hard questions. First, is this an industry-wide problem that will pass? Or is this company's way of doing business becoming obsolete? Second, do they still offer something people actually need or want? Third, can they tighten their belts and stop spending on risky projects? And maybe the most important of all, do they have enough cash in the bank to actually survive this storm without going under? Okay, so let's tie this all together. We know these massive drops are common. We know some companies recover and some don't. So how does this change how we should think about investing? This chart right here, for me, this is the real kicker. Just look at this. On the far left, you have the 20 absolute best performing stocks of the past 4 decades. Their median drawdown was a nauseating 72%. Now look at the worst stocks on the right. Their drawdown was 96%. The difference in pain between the biggest winners and the biggest losers is way smaller than you'd think. This kind of volatility is baked into the system. Of course, it's so tempting to think we can be the smart one, right? That we can just sell before the crash and then swoop in and buy at the very bottom. But as the legendary Bernard Baruch said, anyone who tells you they can do that is a liar. It's a fool's errand. And at the end of the day, that's what this all boils down to. The real secret to building wealth over the long run isn't about being a genius who can predict the future. It's about having the emotional strength, the temperament, to just hang on through the terrifying drops that are an unavoidable part of the game. And that's really the question I want to leave you with. The next time things get ugly, and they will, are you going to see it as a full-blown crisis? Or will you be able to see it for what it really is? The price of admission you have to pay for a chance at great returns. The choice is yours.